Good evening, ladies and gentlemen. I am Forum and I have been hosting these webinars since the lockdown, and this one is our 14th external webinar. Thank you for giving us your love and support. I once again welcome you all to another episode of GEPL Capital's webinar on CEO Talks in association with Aditya Birla Sunlife AMC Limited. Our today's episode is Unlock 3.0. Is your investment portfolio ready? What financial assets to lock with the unlock? Our speakers for today are Mr. Balasubramanian. Pleasure to have you, sir.
Yeah, thank you.
Let me just highlight you so that our guests can see you. Thank you for giving us your time, sir. Mr. A. Balasubramanian is the Managing Director and Chief Executive Officer for Aditya Birla Sunlife AMC Limited and has been with the organization since 1994. He brings with him over 26 years of experience in the mutual fund industry as portfolio manager both in fixed income and equity. Bala sir is closely associated with key industry bodies. Currently, he is on the board of governors of National Institute of Securities Market (NISM), which is a SEBI established entity. He is also on the Committee of Corporate Bond Market Development of SEBI. Apart from these prestigious roles, he plays an active role in AMFI as in board of director. He's also held the position of chairman of AMFI for 2 years from 2016 to 2018. He has done his BSc in mathematics and MBA, apart from being an alumnus of IIM Bangalore and Harvard through Advanced Management Program. Thank you for giving us your valuable time, sir. Our moderator for today, Mr. Vivek Gupta, Chairman and Managing Director of GEPL Capital. He is the founder of GEPL Capital, which was established in the year 1997. He comes with over 25 years of experience in the field of financial services and also is a committee of a broker of BSc. A second generation entrepreneur, he's grown the business to full service broking firm offering multiple investment products. Thank you for joining us, Vivek, sir. We will first start our market outlook by Mr. Balasubramanian, followed by an interactive session by our moderator, Mr. Gupta. As you all know, this is a live event on Facebook. Hope you all will put up your best and like and share us on Facebook with your friends and family, and they will see you all live there too. We are putting up a link for FB in the chat room here. As you all know, we have taken questions from you all on email beforehand. We have received a lot of questions and we will try our best to accommodate those. In case we've missed off any questions, you all can put the questions in the chat room here and we will try best to accommodate those. I now hand it over to Mr. Balasubramanian.
Yeah. Thank you. Thank you for this introduction, and thank you, Vivek ji, for having me part of the 14th webinar series during the lockdown period. I frankly have not counted how many events we have done in the last some number of years. Aditya Birla Sunlife Mutual Fund. I think now it's become a new way of connecting with the people. So again, nice to hear such an event has been going on since the lockdown period. So thanks for making me part of your session. Of course, I'll also look forward to the Q&A sessions, which will probably have it in another 20 minutes time. Very quickly to give a broad market view, and then we'll have a discussion around how some of the questions that you may have in your mind, then how one should whether around such kind of questions and uncertainties or challenges for which I'll try and give you the best possible direction answer to that. With respect to the market, with respect to the economy, as we have been saying for quite some time, the whole COVID is now bringing in the new world completely. I think the way the business is being run, the way the people are connected with each other is completely gone for a change. So therefore, post-COVID, I will naturally get into the new world and the new way of doing things. But having said that, I think this time around, because the COVID impact is so large related to the health, the most of the slowdown that was being expected, both in India as well as globally, the support that has been coming in this lockdown scenario to provide necessary support to various companies and also to provide liquidity. Central banks have been extremely aggressive in providing the support to the system as a whole. We were just doing some kind of number, post 2008 crisis, we're asking a question to ourselves: what is the difference between 2008 crisis and 2008 crisis? Naturally came from financial market crisis, restricted to US, not so much into the other economies. Whereas the COVID is something is impacting the global economy, which all of us know about it. At the same time, the speed at which in 2008 crisis, the central bankers were reacting, the G8 countries were reacting. They were actually assessing the situation at each point of time, and then they kept building the momentum in terms of what they need to provide a support. That kept coming, and took almost about 1.5 years to 2 years to address the whole issue arising on account of financial market crisis that time. Whereas this time around, it completely is different. I think whatever they did almost about a 2-year period, this time they've done it in a matter of 2 months. And then what they have done significantly is actually the big change that has come is the way I think they have brought down the liquidity in the system, increase the liquidity in the system. And when I mean liquidity in the system is actually is money that is being available with respect to Reserve Bank of India in the form of deposits is the one reflection. I think the money has been available in the Reserve Bank of India, getting deployed at close to 3.35% is one of the highest ever in the history of my own investment experience that I have in the mutual fund industry, is being in financial market since 1992. And this is the first time I'm seeing such a large amount lying in the Reserve Bank of India, which has come on the back of the cutting interest rates, providing more liquidity, and so on and so forth. And if you have to draw, I think now people are actually putting this number in relation to the GDP size. I think globally, US and Europe, the support that they are given for providing a support, the support is close to about 14% of the GDP size. I think India is about roughly about 10% they are given, which includes maybe about 0.5 to 0.8% of fiscal deficit slippages, and rest of it come in the form of more about the loan guarantee, etc. The US is a typical model. I think one of the reasons why US market is doing well. US is a typical model where they have given huge support to provide liquidity, huge support actually to the corporate world. They given money in the hands of people. All these things they have done a matter of about 3 months time frame. At the same time, they also kept the economy open, half closed, and so on and so forth. Therefore, the employment rate in the US did not get so much impacted. But the fact of the matter is that the interest rates have come down. So the interest rates have now dropped to such a low level. This kind of interest rates, of course, I've seen it 0.5, 0.6% kind of things. I've seen it and post global market crisis, and such a huge liquidity, which is basically the printing money, which is called M2 or M3. I think printing of money is also quite abundant. So this actually is creating a case, a very clear case for as and when the government gets into action and starts, the economy gets opened up, the spending power for people come back, then we'll probably see a revival of economic growth. That's one. Second area where we have seen a significant improvement as a result of that, the liquidity improvement in the system, in Indian banking system, the interest rates itself has come down. So I remember in the month of March when the whole COVID issues were on, when everybody was trying to actually figure out what is the direction for the market, where the interest rates are going to go, and so on and so forth. Clearly, we saw the significant drop in interest rates in the last 3 months. And today, if somebody wants to say borrow for 5 years, especially a AAA company, the rates have dropped as low as about 5.2%. I remember the month of March, the number was as high as about 8%. Number was about 7.5 8%. There is a 2.5% drop. So one of the big achievements with, I think, from an RBI point of view is doing is the transmission of interest rates, which was the broad. And I mean transmission of interest rates. It's basically when the rates are low for me to borrow, the deposits, then I should also reduce my lending rates. That's I think way the banking system works. So the banking system were not cutting down interest rates. And today there's so much of liquidity. RBI is actually not taking money from anyone who is going and giving us extra money to the Reserve Bank of India at 3.25%, 3.35%. So naturally, it's worthwhile they come into the market for lending. And that's something which I see a greater transmission, which also beginning to happen. And where does it reflect? Does it reflect on housing loans? Housing loan rates have come off to as low as about 7%. When HDFC is today offering for a middle class borrower close to about 7% rate of interest, 7.25, they are borrowing, they are giving money at a loan to value of about 70%. So that's, I think, real drop in terms of the rates. And the third, in my view, which has happened for India, and given the fact that global in the US has been a role model for most of the global economy, the markets are doing well, the regulators are actually is quite proactive, and despite all the odds are not favoring a bullish scenario on US, they are also doing many things right. That's also making them feel that developed market is doing so well, which is US and Europe are doing so well. So there is also a merit for emerging market to do well. That's why now we are saying the last 3 months, India has received one of the highest inflows in FDI and FIIs, more than FIIs flows, FDI flows one of the highest in the last 3 months during this COVID period. Again, it means that from the foreign investors' point of view, I think they continue to look at India as investment destination. When I mean FIIs and FDI flows, I think this time around, all the issuance that are raised, the issuance are given by whether it is some of the banks or raised capital, all of them got subscribed big time onto these things. Basically, they come from government of Singapore, some of the other sovereign funds, and some of the US-based companies have been investing in India, like Blackstone. They have been actually increasing their commitment towards India, and therefore the foreign flows have come. That has given actually stability in the currency. I think if we look at today, the India's balance of payment. Whenever we get into crisis globally earlier, we used to have a currency crisis. But this time around, currency actually has become more stable, and the Reserve Bank of India has been buying dollar and injecting liquid in the system, therefore bringing stability in the currency. Balance of payments are far better, and this actually is also combined with the oil and commodity prices being low in the global market. I think India being one of the biggest importer of oil, I think we also have the benefit of oil price being so low. Helped actually to build the business, building currency surplus and balance of payment positive. So that's where I think the whole thing is moving. Therefore, if you put all these things put together, definitely the macro, there has been a significant improvement. And the inflation, I think we have contained it quite well. Though the recent inflation that some of you would have read the newspaper or newspaper article, the inflation has gone up. That's in my view more temporary. But structurally, inflation in India is going to stay low, which is going to have a long-lasting, low-interest rate regime for at least 1.5 years time free. From the Reserve Bank of India point of view, they'll keep the interest rates low, which essentially means extremely important for reviving the economic growth. I think where we are today, we are at such a juncture. We are actually in the fag end of the lockdown period. Maybe we'll see the lockdown getting lifted gradually by most of the states. The activities will come back. The government of India also has been giving greater support to the MSMEs by providing a loan guarantee and the replacement of what do you call the moratorium to a restructuring of debt also being permitted. And that's again something which I think will ensure that there are no much of default that comes in. Given the fact that COVID has an impact on everyone, therefore we cannot allow them at the same time actually restructure the loan for a longer term that from the banking system point of view. And third, actually with respect to the rural economy, clearly we have seen some positive headwinds for rural economy. It's coming from good monsoon and good agriculture output. And also the government of India focused on more on rural employment as well as rural focus in terms of providing a greater support to the agriculture economy. All these things are pointing towards the next pickup of Indian market point of view is going to come from a rural economy will start from and then move to the urban market. So I see some bit of the consumptions coming back. I think when I talk to actually some of these companies in the two-wheeler space or car space, I think they are indicating that of course the sales in the month of July is better than June. The month of August is better than July. So therefore the number now starts picking in. So therefore that's something which I think is also bringing back some bit of positivity and some bit of hope for the economy to come back to normal. Having said that, from market point of view, there are 2-3 things of course we do look at. One is of course is with respect to the earnings, and then these earnings can take some kind of time, given the fact that the companies in the pharmaceutical space, companies in the IT space, companies in the even the financial space, they all will continue to have an income. So they'll have an income because all of us consume goods, therefore we generate profit for them as a consumer. There are companies in the construction space, because of clear lockdown, they'll naturally will have some postponement of earnings. There will be some postponement of earnings. Even these kind of banking systems, because of lack of credit, they'll have some postponement of earnings. The earnings will not be up to the mark. We could probably see some kind of earnings getting postponed. There are certain sectors in tourism or hospital sectors, because the movement of people is restricted, we'll probably see postponement of earnings coming from even some of these sectors in the hospital sectors. Otherwise, most of the other sectors, one looks at it, I think the earnings, I think, should start coming back as we move forward. Therefore, there is now the reality check between the market and the current what do you call the way I think the earnings are not coming. And then naturally, all of us start looking at one, the earnings reduction is going to be lower than what I expected. That's one, first of all. Therefore, that gives me some kind of margin of safety. And second, actually, the next year, the earnings can come back. Therefore, I think we are at a stage where one thing settled down. There's a high probability, the way the government has taken a call the last 4 or 5 months, probably they will take more steps to bring in some more structural reforms, which could be in the form of, say, scrapping policy for the other sectors, to revival of auto demand, and giving some kind of booster to the power sectors to remove the pain point that they had the last many number of years, to remove the pain points that could come. And third, of course, which I think, as the government of India has announced sometime back in the budget, that providing lower taxation for people who are set up a manufacturing unit in India before 2023. We're already seeing some kind of momentum, whatever reports I read. There is a clear signal is coming from Samsung. Samsung has been choosing Vietnam, China, and other locations for manufacturing of mobile phone, and they have been focusing less on India, but India is actually one of the largest market for Samsung phone. And the same thing which happened in the case of Apple. I think each one of them are looking at relocating during the COVID period, thanks to, of course, China, US concern, and of course, related to the COVID. And they are now looking at alternate destination for China. And that's why I think the money seems to be moving into the India, in certain states like UP and few other states, who have been quite proactive in taking steps in attracting foreign investments into the country for setting up a manufacturing unit. So already we are seeing some kind of positive vibes coming from Samsung, Apple, because the government of India is giving a free land, some special taxation structures. At the same time, given the fact that profit margins are low for them, they're also planning to give some kind of waiver from the sales tax point of view. And finally, they also given the lower taxation up to 15% for such a new units that is being set up before 2023. So this, in my view, can bring in a revolution for India to make the Make in India theme that they are having earlier to become real. So I think if you look at on an overall basis, while the COVID has taken away the economic growth by about 1.5 years, the speed at which the regulators have been functioning, the speed at which they are taking action, the speed at which they are actually willing to change the rules now to ensure that we don't fall. I think we just quickly come back as and come back. I think we are taking many steps, which in my view would actually help the market to get some kind of more buoyancy as a result of that. And lastly, of course, the way I think the Reserve Bank of India has functioned to keep the interest rates low, money being one of the raw material for most of the companies, if that's made available cheap, and then the kind of earnings impact that could have on the borrowing of these companies, borrowing of these companies would also have a huge cascading impact in improving the earnings as and when the things come back. So that's something which I see broadly, I think, how things are shaping up. Clearly, I am the one who is reasonably bullish on the medium to longer term. We will have some concerns in the short term that, okay, market has gone up so much. Am I getting into the market at a higher level, and so on and so forth? And there are many such questions will be there. But given the fact that the pandemic has made so much of outcome coming from central bankers across the board, and so much of liquidity has been pumped in, this will definitely have some kind of long-lasting impact in helping the economy to come back. With respect to few other trades, I think clearly globally few things which are also showing some kind of sign apart from India. Commodity prices are showing some kind of strength. There's a clear equilibrium as now is coming in the commodity sectors. That's something seems to be falling in place. Second is globally real rate of interest is negative. When I mean real rate of interest is negative, if I buy a 5-year bond, a 10-year bond in US, I get about 0.5%. Whereas if I buy a gold or maybe an equity, either I may get zero return or I may get a better return. The probability of getting better return more than 0.5% is far higher in equity and gold, and that's why I think money is actually moving into this kind of asset class globally. So these are some of the things which, in my view, seen as a positive signal towards the equity market globally. That's also something one should keep in mind, because at the end of the day, we all as investors within India, we look at India, we consider India, absolutely no doubt. But I think global trends are indicating something beyond what we are seeing in India. Therefore, that cannot be ignored in the investment world when we have to take a firm view on any investment of asset class, whether it's in equity, whether it's in debt, or in gold, or any other asset class, including real estate. I think I'll stop here. I'm sure a lot of questions will be there. I'll leave it to Vivek to grill me over the next 20-25 minutes.
So thank you, Bala. Thank you for sharing with us your optimistic view. It is so heartening and provides us with a lot of relief. Also, I think you highlighted some very important correlations between 2008 and the current scenario, where liquidity was pumped in 2 months versus 2 years. I thought that was a very good observation that you brought about. So thank you so much. Bala, we took some questions from our fellow participants, and we've structured it in such a way, we've divided it into the economy, then into the equity part, and then some concerning debt. So the first question is regarding from the economy. This year, everybody is projecting a negative growth rate for the GDP. Next year, they are projecting a positive growth rate for the GDP. You also mentioned you are seeing a pickup in the rural and the auto space. Do you actually see consumption demand picking up next year? Because the real problem is really consumption, right? Because if there is no demand, what will I produce? So do you see this positive GDP flowing into consumption next year?
Yeah, I think the way I see is the consumptions will have to come back for two reasons. One, of course, at the current juncture, most of the people are in a preserving mode, and people are not in a spending mode. People are in a preserving mode. Second, last 3-4 months, as the lockdown have also changed the way people have been realizing that what to where to spend and what not to spend, and so on and so forth. So that realization definitely has come. At the same time, I think the spending would also come back. At the end of the day, I think after sometimes, this will become it will be one of the event which will completely people forget about it. It will come back to normal life. And second is the basic needs of every consumer can only be postponed a bit. Cannot be completely avoided from the point of view of spending. So the lifestyle of people, I think for the middle class, there are certain things they continue to keep it. Therefore, that consumption will come back. And third, of course, with respect to why the consumption could also come back, once the interest rates are so low, when the liquidity is so low, and bank deposits are giving only about say 5.5-6%, and that too for a longer period, then naturally the choice will come for the savers. Should I save? Should I spend? Or should I say or invest in some other asset classes? Whether it can give me a better return and so on. These are the common questions which start coming in. And finally, from the government of India point of view, if they give so much of the inflation, keep the inflation low, and they also ensure that the output in every segment actually improves. Therefore, that can lead to a better cash flow in the hands of people, especially in the rural economy, as you mentioned about. Therefore, it can lead to the consumptions coming back. The speed at which is coming back probably could be initially less, and maybe it could gradually come back. I think as we move to 2021, we'll probably see the consumptions coming back to normal. One of the areas where I'll see the big trend change is coming, I think because of social distance as a concept, already there are indicators coming in that better I buy a two-wheeler, which I was not buying earlier, because of the social distance we have to maintain. So there is a growing feeling that let me buy a two-wheeler. If somebody has got a two-wheeler, there is a growing feeling that let me buy a small car. And again, the social distance seems to be, people are also a little bit afraid of using the public transport. I think there was a period just about a year back, everybody was making a pitch in India that the Indian public transport system has become a lot better, like US or like developed economy. And now I think it's a bit reverse, right? I think people are a bit afraid of traveling in public transport. They want to have own vehicles. Therefore, that segment of the population also now has grown. So therefore, the consumption theme, in my view, we will probably see initially taking a break for a few months. I think it will come back.
And probably that tallies with what you had said in your opening remark, that there is a pickup in auto. So, I mean, it kind of collaborates that, yes, two-wheelers are picking up, and you said the lower.
Right. So one of the things I wanted to highlight, Vivek, I was sharing, I was in a panel discussion with one of the managing director of promoter come managing director of a tractor company from South. And this is almost about 1.5 months back. When we were in the panel discussion, after the panel discussion got over, generally when we were discussing about how the business has been going about for her business, and she said, well, I'm seeing one of the best quarter ever in my lifetime in the tractor business last number of years. April, May, June, she said one of the best quarter for tractor sales.
Wow.
So a tractor sales, a buyer of a farmer who wants to actually get the vehicle after seeing it, after having multiple round of tests, only after he does it. In a virtual platform, they had the highest number of sales.
Wow. Truly
there
amazing.
are certain segments we will not understand, but I think that's the reality.
Yeah, truly amazing. Next question, Bala, is that, for 18 years, the first time in 18 years, we've had a current account surplus. What does this actually mean for the country? Does it actually mean something, or is it just a number that is there?
Yeah. No, current account surplus means that I think we can afford to keep rupee bid and appreciation bias. And in the sense that if there is no demand for dollar, and you don't need to do a huge reserves that you need to build, and current account surplus, you can actually make it more deficit. In this process, you can actually import more. You can import more. That can come as a cheaper cost. At the same time, you can also create rupee to appreciate a bit in order to ensure that whatever the money is coming in, don't keep buying at a higher dollar. So balance of payment surplus is actually truly indicate how a country as a whole is managing their import and export balance. The way I see it, one of the things that in the balance of payment currency reserves we always look at, the currency reserves for what is like how I have money in my bank balance against my expenditure, and then I say I have a bank balance which will take care of my expenditure for a period of say 3 months, 6 months. And the same way, if you have to just draw a parallel in the currency reserves versus my import bill, it can take care of my 15 months of import bill. The 15 months of import bill is quite a lot of money for giving a comfort. Anybody who puts money in overseas investors, he looks at balance of payment problem. If the balance payment has a surplus, if the current account deficit is not there, then naturally currency risk is not there. See, we as an Indian sitting in India may not pay much attention to the rupee dollar movement, but overseas investors do look at big time on that. And this also reflects the state of the economy, the way they are managing the trade balance on both on import and export. So therefore, very important. Balance of payment being surplus is a great news. And of course, sometimes we do say marginal deficit always good rather than a surplus. There's some deficit is always good.
Good, yeah. So, Bala, this follows to my next question. I remember, when there was a crisis in 1991, we just had probably 1 month import. To that extent, we had foreign exchange reserves or less than that as well. And now we are in a situation where we have 15 months of import cover. And you also mentioned that in the last 3 months, the foreign exchange FDI flow into the country has been large. So the country has been accumulating a lot of foreign exchange reserves. So is this a good thing? Is that useful for us? Or how do we, as a follow-up to the earlier question?
Yeah, I think these currency reserves, I think is very good to provide a greater comfort to predict how the rupee dollar will move. The reason why I'm specifically saying this is, so let us just assuming a scenario that somebody come from overseas, from foreign, and then he buys into a Indian debt, giving a yield of say 10%. Let us assume I'm taking 10%. 10% today the rate is not there, but let us assume 6% is somebody is buying, and 6% per annum is buying. Suppose the rupee depreciates because of the uncertainty in the rupee dollar market, and then depreciate by say 3%, he effectively get 3% dollar return, and he get 3% dollar return, right? If it is depreciation of 3 rupees. If the depreciation of 2 rupees, he gets 4% return. So this depreciation prediction comes on the base of how much forex reserves you have, then how much support you will keep, and in terms of making the rupee dollar not appreciate or appreciate, and how stable your currency would be. All these things will determine on the base of the inflation adjusted return differential, and also the currency reserve that we have. Therefore, the currency reserves play a very important role in determining the health of the economy and health of the outlook on the country. And that's something which I think from India point of view, I think we have done reasonably good job of taking the currency reserves to about $540 billion. Whereas China, if you take, it was almost as is about some $4 or $5 trillion, from somewhere around $4 trillion or something currency reserves. Now I think it's dropped, I think, if I'm not wrong.
1.3.
Yeah.
So, Bala, just getting on to our today's topic about unlocking 3.0. What do you suggest that investors should have as the right asset allocation looking ahead towards the current GDP, which may be negative, and a pickup next year? So how should investors, what kind of asset allocation do you advise?
Yeah. So, Vivek, interestingly, this question often comes at every point of time, irrespective of whether it is a pandemic, not pandemic, and so on and so forth. And this question not just comes today. For the last 30 years, I've been in the market, I keep getting the common question. So I have two formula for this, which is one, my own personal experience, and in order to ensure that we get a reasonably good experience over a period of time. The two formula is like this. One, at any point of time, the asset allocation, which I'm a firm believer, starts with 50-50, 50 in debt, 50 in equity. And then depending upon the age and what is the purpose and how long you have tolerance that you have for both asset classes, and you move this needle between equity and debt. And some portion, of course, can go into the gold. But I'm again firm believer, gold not necessarily ought to own it. The one asset class can give you a similar kind of gold experience in terms of the return of say 5-6% kind of things. The liquid fund itself can give you. So, so therefore, normally I don't have that much of an inclination towards gold. But I think longer term, and gold asset class, everybody wants to own it as part of their treasure. Therefore, that could be one asset allocations. The second allocation pattern, which normally I keep, if you take the 4 asset classes, every asset class has got a expectation of return. I think that can vary from time to time. So I'm giving expectation of return. Let us assuming if I have a 5-year bond return, say gives me 6%, and 5-year equity return could be say 12%. I'm just giving an example. And then the gold can give me say 5%, and then real estate can give me say 8%. So I'm giving you all the three and as an expectations. So let us assuming these expectations get materialized. Then actually on the base of these expectations, I ensure the money is given actually in all the 4 asset classes.
Yes.
So if it's a 14, if it's an expectation of equity, I give a higher weightage to equity. Of course, 100% money will not go there, even if it's 14%. But maybe about 40% or 50% will go to equity, or 60% will go to equity. Then on the basis of that return expectation, so this is the model which normally I'll apply, that at every point of time, we need to take a call, which asset class in the current scenario can give me better return. And then once the portfolio is constructed like this, then you have to only keep tinkering, increase your equity, reduce your debt, and increase your debt and reduce your equity. And this actually keeps moving up and down. I think if you're able to get this formula very smooth, then the overall portfolio of the portfolio will be very good. Then we don't curse ourselves saying, I put all my money in equity, it's giving negative return, what should I do? and I put all my money in say credit fund, suddenly I'm losing money in credit funds and so on and so forth. This question will not come.
So from that, Bala, what about global funds? Do you recommend any kind of exposure for individuals to global equity?
Yeah, I think naturally one of the area, of course, I think global fund, it makes sense for people who have reasonably good money, and especially HNIs. Even MHNI also can look at global equity as part of one allocation within the equity space. It actually serves two purposes. One, I'm able to make a dollar portfolio. At the end of the day, the global markets are getting, in some sense, converged. So having a dollar assets, given the fact that having a dollar asset, being an Indian, we cannot have a dollar assets. We cannot open a dollar account. Of course, Government of India permits a dollar account to be open now. Current account you can open. At the same time, you can make up to $250,000. You can invest overseas, because every individual's, somebody other than the house, either they travel overseas or they build longer term future in overseas, they get employment overseas, or maybe they want to settle down in overseas, they want people want to migrate. For all such purposes, I think global investments are being permitted. Therefore, that in my view, one should take some bit of usage of that and then look at global investments also in that. The other advantage of global investment, I'll give you one simple example, whether it is take Google or Facebook or Apple. All these companies, they are based in US, but they are benefiting out of their presence in China, India, and so on and so forth. Very fact that they are not listed in India, I cannot play those stocks in India. Only the way I can actually take an exposure on my expenditure in Apple buying in India, but benefit out of that in buying a stocks in the US, in Apple stocks. So that's the way I think I want to look at it. I'll give you another example in India. So first of all, Tata Motors, we think actually Tata Motors is an Indian company. It is an Indian company, no doubt. But the moment China does well or Europe does well, naturally Tata Motors actually start benefiting, because they are no more a company which is dependent on India. They are dependent on China, US, Europe is gone up so much. Therefore, Tata Motors, a common man who looks at the market, he will think Tata Motors is not doing well or doing well. But may not be doing well or doing well because of, not because of India, because of global market. Therefore, having a portfolio of some portion of your portfolio in the global investment is actually is advisable for the investors.
Thank you, Bala. Now, moving on to the equity section, Bala, you had mentioned rural and auto as a sector that you are seeing a little bit of pickup. Are these the sectors that you would be overweight in your portfolio?
Yeah, rural definitely we are overweight, Vivek, the sense that I think the way we are considering the portfolio, I think in the pecking order, we are overweight on pharma as a sector. Given the fact that pharma is a bit immune to COVID, because it's providing medicine, therefore it has to be immune. Absolutely. And second is agnostic to the policies, whether interest rate is low, high interest rate, doesn't matter. And now health is becoming a big focus area. Therefore, the spending towards health, I think, will go up quite significantly. Therefore, the pharma sector will become overweight. Then second is, of course, is the agnostic to all those things, the technology. The technology is actually today is becoming a lot more compulsion to have it. So therefore, technology space, digital technology space, I think will do well. So we are actually equal weight or overweight marginally. And then comes actually is the material sectors, which of course rural theme, including cement sectors, rural demand will come back. That's something we have. With the auto, we are not overweight, but of course we are getting in there in the form of owning the two-wheeler companies and some bit of car companies. So we are still not formed a view on passenger cars, how it will pick up, or maybe how the commercial vehicles are going to pick up in the country. And given the fact that whole transportation system, logistic transportation system is still at a loggerhead because of COVID, and also demand supply is not in favor of demand coming back because the flight operators will have their own challenges and so on and so forth. Therefore, that segment is still not got in. But at the same time, auto ancillaries, and given the fact the replacement market is pretty big for them, and after having seen such a sharp fall, we are seeing some bit of recovery could come in the auto ancillaries, and therefore we have built some kind of exposure in the portfolio. So there is no something which you can say we've gone completely overboard. The portfolio construction has to be very balanced as far as we are concerned in order to deliver performance in the long run.
Thank you, Bala. One sector which had a lot of hope but did not deliver was infrastructure. Okay. Do you think that now is a time, considering where we are in the economy, for somebody to invest in an infrastructure fund or to start an SIP in the infrastructure fund? Because it's been something that was a hope trade or a hope sector in 2008-9. What's your view on that?
I think infrastructure sector is one sector. While the life of the infrastructure is long term, but the life of the companies in the infrastructure space becomes too short term. In the sense, the earnings become too volatile. They are bound by various regulatory changes. They are also bound by some of the disruption that comes in. Policy making, government involvement is too high. As a result of all these things, they don't make money for the shareholders. The infrastructure companies, especially those who are in the high capital intensive business or maybe heavily regulated entities with them they have to deal with, they don't make money for the investors in the long run. So therefore, from a SIP building point of view, I need to get into sectors or portfolios which does not have a specific focus on one segment of the market. No doubt, infrastructure space, it just took off in 2008, no doubt, but that didn't sustain because the sustainability of this sector, I think, gradually started waning. So therefore, that's something, if somebody has got exposure, I would always say it's better to play the bank infrastructure sectors, the banking and financial sectors, which is a permanent theme, proxy to the economy. They do deliver, controlled by Reserve Bank of India. They do deliver return in the long run. That's one way to play that sectors instead of going through that particular sectors. But within the infrastructure sectors, there are companies that are like capital goods sectors. They are actually part of the infrastructure sector, providing automations, etc. But all of them, anyway, we own it in the diversified equity portfolio that all of us run. Therefore, my view is infrastructure is a theme. I think the one theme I think is very good for India. I mean, the consumption theme. Permanent, no regulatory hiccups. You and me as a consumer, if they spend, companies do well. Not depend on government policies, not depend on any other support. They are on their own. Balance sheet is very, very clean. Borrowings are the least. Therefore, consumption as a theme, I think will do well. For example, we run one fund called Gen X Fund, and not many are aware about it, not many talk about it, not many recommend also. But this fund has done extremely well because I invest only in those companies who buys product from the companies directly as a consumer. 55% of the sales of these companies which are making investment, above 50%, should go towards direct customer. Customers go and touch the field and buy it. That segment, in my view, has done extremely well.
Interesting. Bala, let's move to another segment which was the darling in 2018, but now is probably getting some traction, which is the mid-cap, small-cap space. Now the dollar has depreciated. There seems to be a theory saying that we could see some money flowing into the country. The small mid-caps seem to have picked up a little bit abroad. Do you see now that the pain of 2018 is now behind us, and now small and mid caps could also be a source of investment for people?
Yeah, I think it's a good observation, Vivek. Clearly, if you look at 3 years, the sector post 2018, it took a beating. It took a big beating, and it was one of the best sectors till 2018. And people thought that a big money, big alpha can be created by mid cap. Absolutely no doubt on that. I think post 2018 NBFC's market crisis, and which we saw in India, financial market went through a tough time, especially for certain sectors in that space, and that created an impact on the whole mid and small cap space. Of course, combined with the economic slowdown, no doubt. So I think we are at the stage we have seen about 2.5 years of bear market for small and mid cap space. And given the fact that the government of India has brought a lot of focus on MSMEs and SMEs from the point of view of providing greater support, And very clearly they have defined that how MSME and SMEs have to be supported in the current scenario by providing a guarantee for their borrowing, which is something which India has never done in the past. And this kind of move, I think, would help a lot of these young entrepreneurs or maybe companies that are small in size would come back. At the end of the day, the companies' valuations are cheap. The good companies where the valuations are cheap, operating the business, who have been in the business for multiple generations, but they remain small. All such companies, in my view, would come back in the radar, benefiting out of the low interest rate, benefiting out of the government push in terms of economic recovery that could come. And third, of course, the kind of support they are providing with 9.5% interest rates, borrowing that they can do. All such things, I think, would help in the mid and small cap space to come back. And that's something, in my view, we may probably see a greater performance coming back from that segment of the index.
Bala, we received one question from an investor. The investor says that I'm an investor with GEPL since 12 years. I've bought my clinic with liquidating my equity holding. What's your view on SIPs? And is there anything that you would recommend? Because considering that a lot of people in the last, say, 3 years have got virtually no return.
Yes.
So how would you address this question?
See, SIP, I think, is something has to be, should never be questioned whether SIP is giving return or not. The reason why I'm specifically saying this is post 2008 crisis, the market did not go anywhere for 3 years. I used to see some of my own colleagues from the Aditya Birla group and rest of the places. They used to call me, Bala, I'm putting money in SIP, is showing a negative return. What should I do? Should I redeem? This common question is to come. And that time it was painful, no doubt. 9, 10, 11 was painful. 12 was also painful. I think the real pain got reversed in 13, 14. In 2 years, 14 was a very good year. 14 was also the best year. 16 was a little weak year. 17 was also a reasonably good year. I think if you look at this kind of model, 1 or 2 years of equity market, good market, followed by 2 years of bad market, or 3 years of bad market, again 2 years of good market. That's the cycle in which we move. So when we move in such kind of cycle, I think SIP and asset class at least ensure you continue to keep your focus on investing in equity, continue to build your long-term portfolio, and continue to keep the fight on the equity for long-term wealth generation. I think that's that discipline that comes in. And the equity market rewards people who has a discipline of investing in equity and a continuous interval. That's something which I think I would recommend SIP as an asset class. You should not suddenly create a doubt on that as an asset, as a way of investing, because it's proven for many number of years. No doubt, last 3 years returns have been not that great, and we have seen this in the past. We go through the cycle. One good market, that is assuming 2022 turns out to be a great market for India, as I mentioned earlier, with V-shaped recovery coming in, and 1 year the equity will give a return, and that's the way I think I see it building it. But at the same time, when building SIPs, don't choose the sectoral fund. The sectoral fund will go through ups and downs. We may probably get caught in the space. Therefore, choose an SIP either in the small and mid cap or multi cap fund, or even the MNC kind of fund. You can choose in that so that you can continue to make your investment for the long term. When I look at the companies, I'll give you one simple example. I just want to give you, since you are put in your own business. One of the company I used to always analyze, which is basically P&G and Gillette. And all of us know Gillette, we use it for our shaving every day. The usage is very high, and a great company. All of us buy Gillette only. Most of the people today buy in Gillette, but sometimes the stock do not do well. Despite me buying, sales are getting done. The reason is, on the basis of expectation, stock price get pushed up. Then the earnings comes. Then the stock price doesn't go anywhere, stay where it is. Then earnings comes and hits the top. Then the further movement happens. That's the way these stocks perform. I have seen these kind of examples for Gillette. I have seen this in P&G. I have seen this in Nestle. I have seen this in Lever, and I have seen this in Godrej. All these companies, if you see, I'm taking all the familiar names. Sales happens, profit they make, but stock price do not do that. Suddenly, the profit is coming, stock price do well. This I'm calling it as a 2-3 years kind of cycles. I think SIP also behaves in the same way.
Correct. I think interesting. I think there's always that pull between high P, low P, and then suddenly there's a consolidation in the market. So I think what you're saying makes immense sense. But just moving on to the debt market, uh, nowadays people are looking for fixed returns. Okay, and with interest rates coming down, what is your suggestion for debt? How do investors look at a regular stream of income? What should be their approach?
For the say regular stream, I think interestingly, I think we try to do this in the mutual fund space, and I think regular stream is something which is basically the monthly income or quarterly income, and so on and so forth. I think definitely today receiving any income from mutual fund in the form of dividend, it's a little costly. In the sense that there is a 10% TDS that's coming in, and therefore that much more return is taken away. Unlike a bank where you can give your 15H forms, other things, and you can tell bankers not to deduct TDS, where the mutual fund doesn't work like that. The best way in the mutual fund space, you get your stream of income. One of the principles I always apply is that if my expectation is, say, in my regular stream of income is say 8%. Let us take 8% is my stream of income is 8% that I need per annum. And then I would ask the obvious question. I go and search for a similar product in the market in the banking system. Will I get 8? Will I get 9? Will I get 7? If I come to an answer that I'm getting 7, then naturally I should not withdraw 8, I should withdraw 7. Because at the end of the day, what you can earn only you can withdraw. Therefore, one of the options that I think to get a regular stream of income in the mutual fund space, withdraw small amount as per your requirement, either quarterly meeting your quarterly obligations or monthly obligations. You withdraw only to the extent of that. Let us assume you put a number of 7% of your capital, you will withdraw every month. Keep the rest of the money for long term. And if you allow this to the long term, I did one chart, I didn't have the chart right now. I did one chart analysis in the MIP schemes, monthly income schemes, I did a chart. I've assumed I withdraw 7% every month. And then when do you actually, do you earn your 1 lakh rupees remains 1 lakh by withdrawing 7% every month? Or 1 lakh become 90? Or 1 lakh go to 1 lakh 10,000? That same thing number, if it comes to 90, if I give a short time frame, because I keep withdrawing 7%, of course 1 lakh becomes 90 because I withdrawing my own money only. The moment I give a longer time frame, the 1 lakh becomes even after withdrawing every month by 7%. Therefore, when I do a systematic withdrawal, keep the money for long term, but withdraw not very large amount, ranging from 6 to 8% you withdraw every month or every quarter. That will take care of your streamlining of your monthly income that is coming to you. You assume it's income, though your own money only, but you assume it's income. That's the best way to deal in mutual funds and form a systematic withdrawal plan.
Okay, excellent. Forum, I will leave the, thank you, Bala. Forum, I'll leave the floor open for more questions from the participants before we ask anything more.
Thank you so much. Thank you, Bala sir. Thank you, Vivek sir, for this fruitful discussion. We now move forward to our question and answers from our guests over here. The first question coming in, Bala sir, is, as large cap stocks perform lower than mid and small caps, can we go for mid cap MFs or to multi cap MFs?
Yeah, I think the way I see is at the current juncture, I think multi-cap and mid-cap makes more sense. Given the fact that I mentioned earlier, one, they'll probably see a broader participation coming on the market. And if you look at the whole, so far in the large cap, the 5-6 stocks have been performing and the rest of the stocks are not performing. You'll probably see the rest of the stocks guys start performing because of the reason that I highlighted earlier. Therefore, I would assume any incremental money that one is looking at, one can move between multi-cap and mid-cap, but keep a time frame of 3 to 5 years.
Thank you, sir. The next question is, with the situation in the month of March and today's situation, whether things are normalizing and the economy is opening from lockdown, where you see the interest rates moving up from here, and what's your view on 10-year government bond benchmark?
Yeah. So I think interest rates, at least in the near term, at least for next 1.5 years, doesn't look like is going to rise, supported by comfort that's coming on inflation. And we need to worry about interest rates in 2022 year end when the inflation globally starts rising marginally. So I think that will depend upon that. So therefore, the US interest rates I think will be at risk. I mean, Indian 10-year bond yields is already at about 6%. We will probably see the 10-year bond yields going up to about 6.25 is quite possible. I don't see too much of pressure coming on the 10-year bond yields, given the fact the liquidity is high, banking system is not lending. The moment 10-year bond yields become say 6.25, you will see most of the banks jumping and buying, and PF will start buying. Therefore, I see actually the 10-year bond is getting capped between 6 to 6.5%.
Thank you so much, sir. The next question is, can you throw more light on investments in gold and silver? Why currently these metals are priced very high?
Yeah, I think interesting question and the interesting trend as well. Of course, the reason why gold and silver, even most of the people were not comfortable buying into the gold. One of the main reason the gold is actually is in demand. One, first and foremost, the real interest rate is low. And if you take US, you have 10-year bond yield say 0.5, interest rate is 0.3, you get only 0.2% as a real rate of interest in US. Very, very small. So rather go and take an exposure in gold. That's one way I think money is coming to the gold. And the second is gold acts as a dollar. Even as an Indian, when I buy gold, first they actually look at the dollar price, then they convert and then look at the domestic price, right? Therefore, it becomes a dollar equivalent currency. Gold is a currency, silver is a currency, except that I get the price moment. So it's like a currency and I get a return as well. So that's why I think most of the money has been moving into the gold. And these are asset class, there's no incremental production. So unless, say, for example, in silver, unless you produce more zinc, there is no silver. So if I produce more zinc, I need to have more demand for zinc. They're all industrial metals. And that's the way I think this dynamics works. I think the demand on gold and silver is coming as a protection to the inflation, protection of the recession, protection of the dollar, protection of the real rate of interest being low. And that's why I think gold and silver demand is coming. Which in my view, I think one should have some exposure to this kind of investment. Also, one should remember gold and silver, if I have to draw a 10-year line, will give you average about, say, inflation adjusted 4-5% return.
Thank you so much, sir. The next question is, how much crucial will be the role of government capital expenditure in infrastructure sector going forward in Unlock 3.0?
I think definitely it would have a huge role they will play. And given the fact that the government of India is the biggest spender in the capital expenditure, and government of India has to play a bigger role in driving the infrastructure development in the country, whether it is the metros, whether it is roads, whether it is a port, whether it is an airport, everywhere the government involvement has to be the highest. And that being the case, government capital expenditures towards building infrastructure in the country will remain the key. Second is how to bring in partnership. At the end of the day, public-private partnership is a model in which I think India has been building it. I think that public-private partnership, how they are able to actually make it successful, which they have done in the road case in the last few years, and also to make those infrastructure a self, generating model. For example, if I build a road, a toll collection on the road will make the project more viable. But the thing is, how to actually create a right environment for that, I think will be key. I think government role, especially on this space, will be extremely important to watch out. And the government, in my view, is also equally committed to make Indian infrastructure as one of the driver for creating a demand for labor, creating a demand for cement, steel, and also driven consumption. All of them actually related to that.
Thank you so much, sir. The next question coming in is, so with respect to the consumption theme, as you mentioned, most of the large cap stocks have valuation close to more than 50 PE. In most of the upside is captured. Most of the volume growth is discretionary. Portfolios have been small single digit growth or negative growth.
Yeah, I think at least the function of demand and supply. Of course, the P multiple, I have always be a believer. P multiple is a function of two things. One is the earnings, which is real. Second is the optimism, which is the hope. And as the hope and optimism increases, a P multiple keep expanding. Earnings may not come. Earnings actually always follows. So the earnings comes later, and optimism comes first. And today, for the market point of view, optimism has come very quickly. See, initially people are not believing optimism is coming back in India. And then we all have copy what's happening in US and Europe and global market. And that's where I think markets are linked today. Therefore, the optimism and hope on the equity market keeps rising. And that I think is push up the PE multiple. Therefore, if you start looking at the PE multiples and then say, no, it's too costly, or I'll not invest, and that's when we all make mistakes, even as money managers. Anytime we make mistakes in looking at the PE multiples, saying earnings are not there, and that's the time I think market actually goes ahead of us. So this is a cycle in which we live. Therefore, this fact of the analyzing companies cannot be ignored, however good you are, whoever you are.
Thank you so much, sir. The next question is, when do you think the upcoming elections in the US impact returns in equity as well as commodity?
I think it's quite possible. That's one of the worry which is there for global investors at this point of time. There are two worry which was there. I think one of the worries somehow is getting ignored, which is the US-China trade war. What way, where will it take it to, what kind of shape will get? Frankly, nobody knows. I think nobody is able to actually predict. This is one unknown. The second unknown is actually the how the election outcome is going to play out, whether it is Biden or Trump. Of course, the probability of Trump coming, people are actually assigning a higher probability. The moment Trump comes, whether the kind of economy concern that's getting built for US, can it be addressed if Trump comes back? Anybody who comes back, they'll still have a problem of repairing the US economy, especially on fiscal. They are given so much of stimulus, somebody they have to start withdrawing. Therefore, it's not going to be an easy task. That's why if you look at global market, when I talk to a lot of people, they all now turning bullish on emerging market than developed markets. I think the reason I mentioned about earlier, most of the foreign firms will come into India, is now suddenly the next 10 years of bull market, one is predicting for emerging market, and which you have seen in the developed market for the last 10 years. Which US and Europe has been one of the best market for the last 10 years, are not emerging market. It looks like the reversal is coming.
Thank you, sir. The next question is, just for our guests to know that we won't be taking any stock specific questions. Bala sir, the question is, however, if you could just give us an indication of the sectors over a 5-year return or a 5-year horizon.
See, I think return, as I mentioned about clearly is I think consumption. I think at this juncture, I think pharma. I think on a 5-year view, pharma should do well. Both MNC and domestic pharma companies. I think there are pharma funds are there. And second is, I think consumption thing which I mentioned about earlier. I think that should do very well. And probably we'll also see at the right time, banking and financial sectors have got beaten down very badly this year. 1, 2, 3 years returns have been negative for banking and financial sectors. Let another 3-4 months passes. Another 3-4 months maybe gets over. I mean, the moment you see credit growth coming back, I think banking and financial sector I think should also do well. Maybe 22, we will probably see banking and financial sector be in the last sectors to get some attention for the market.
Thank you, sir. The next question is, premium hotel scripts are quoted low now due to the pandemic. Do you think this is an opportune time to invest in these stocks?
So I think interesting. I think the whole tourism sector is getting impacted. Definitely has had an impact on the hospitality sector, especially the hotel industry. But if you put a value to the assets, and basically replacement value if I take, and also the potential earning that it can give, so naturally valuation wise become cheaper. But the question is what kind of occupancy will come, because the last 7-8 years this sector has not done well, not because tourism were weak, because of oversupply. I think with oversupply, these people have become cost conscious, and therefore Therefore, and the tourism was very mixed, and therefore the sectors that didn't do well. But naturally, I think if you look at the valuations versus that is they are trading and the potential assets they have created, asset value replacement if you have to take, then naturally it makes sense actually for the sector to be looked at. But having said that, these are some of the dynamics will continue to remain as a factors which will keep challenging the price movement.
Thank you, sir. The next question is, need to know what all is required to develop the bond market, particularly from a retail point of view.
Interestingly, I'm also part of that some of the committees in SEBI, and this topic of discussion we have been having it for so long. I think the bond market from retail point of view, I always believe the best the retail investors play the bond market is through the mutual funds, mutual fund fixed income schemes, and not many investors do understand fixed income schemes because the NAV fluctuates. Suddenly they feel there is a credit loss that has come in some schemes, therefore they think this is bad. And believe me, fixed income asset class in the mutual fund space, they provide a greater opportunity for retail to participate. If you buy a bond, then there is a credit risk, everything you have to take it and you have to analyze it. And bond buying and selling is largely restricted to institutional investors. Therefore, the retail investors, while all of us have been trying to build bond market for retail investors, I think the best way, in my view, to participate in the bond market is through the mutual fund space.
Thank you so much, sir. With this, I now hand it over.
Forum, there's one more question regarding, so there's one more question. ABSL equity hybrid fund, is it good for long term? Some clients have invested in 2018, but they're saying the return is still negative. So what is how should they deal with such thing?
Yeah, and of course, in 2018, we went through some challenge in this fund, of course, as happened to every fund in the industry. That challenge, which I think we have got it corrected in the current year. So therefore, I will probably see a greater what do you call movement coming in this fund. Therefore, if somebody has got investment, I would encourage them to hold on. And somebody wants to make a fresh investment at 1195, they can do so, given the fact that portfolio, whatever we have to make course correction. I call it the course correction. Every portfolio will do a course correction, ongoing basis, depending upon how the market is behaving, how the money managers are making their calls right or wrong, and so on and so forth. That, in my view, we have passed the stage, and therefore we'll probably see going forward the portfolios generating either market-linked return or better than that. So therefore, if somebody wants to even make an investment, I would probably suggest they can do so.
There was another question regarding another fund for which schemes were stopped, but we can't take that because it doesn't concern.
I think your voice is suddenly low. I think just a second.
I can't hear you.
I said there was another question regarding another.
So we still can't hear you.
You said there is a question, which of course I saw one question about airline industry, right?
Yes, sir. I'll just read it out to you. What way forward for the airline industry? They are unable to capitalize the benefit of low oil prices and also struggling with high fixed costs.
Yeah. So I think airline industry is actually the it depends upon what is the passenger traffic. I think the passenger traffic is the key for this industry. Given the high cost nature of this industry, right from leasing a plane and spend money on the fuel and also the airline staff and then government various taxes that they have. Then naturally, I think from India's point of view, I think it will have its own struggle with respect to the dynamics, economics model. Naturally, this needs a lot of the passenger traffic. They higher the occupancy rates and they higher the probability of making a success. Including Southwest Airlines in the US, have gone through some tough time recently. But at the end of the day, the most of the cost efficient model in this sector will do well. Leave aside industry as a whole, I think anybody who actually very high cost focus, for example, Indigo is one company which I admire for, not because of anything else, very high focus on cost consciousness, very high focus on balance sheet, very high focus on the way they manage their employees' strength and so on and so forth. And this is the kind of model, if you have a very high focus on the cost management, I think can survive in the long run. But as I think airline industry is being one of the hospital industry, may not make money for the shareholders, but they have to anyway be there. So whether they incur a profit or not, they have to be there in the industry, given the fact that remain one of the core transportation industry in the world. And therefore, this is something that can provide greater employment. From money making point of view, this is something I think we'll have to just watch out at the right prices.
Thank you so much, sir. With this, we take our last question for today, which is a Facebook Live question. When do you see the banking sector start to pick up? What would be the key indicators, and what would be the impact of unwinding of the moratorium provision in the financial statements?
Yeah, I think interestingly, I was in the ET Now interview yesterday morning. So I answered exactly the same question on the lead indicator. So one of the lead indicators I do look at is on the way I think credit offtake will come. And second is the way moratorium getting converted into restructuring of loan. And then the corresponding resultant, what do you call, NPAs getting provided for. I think these are some of the indicators I think one has to look at it. I think if the interest rates even marginally move up in the 2022, is a positive for the banking industries. We'll have a positive correlation. Interest rates going up will have a positive correlation for the banking industries, because the higher the rates, higher the income, and then credit growth coming back, it actually will be a good signal to a pickup. So right now, if you look at all these areas, there are no major signals coming in. Therefore, we may see the sectors being undervalued, cheap, corrected quite a lot, but it may remain so for some time in the absence of credit market picking up.
Thank you so much, sir. We've received an overwhelming response, and we've tried as much as possible to cater to the questions given to us. I now hand it over to Sharmila.
We thank our speaker and moderator for joining us today. A big thank you to ABL RM, Mr. Kapil Sharma, and Area Head, Mr. Arun Mohanty, for organizing this webinar today. Maybe have you say something, Arun, sir?
Yes, I think thank you very much, Bala sir, for answering so many questions to our investors, to our participants in this call. Thank you very, very much, Mr. Vivek Gupta ji, for and GEPL team for giving us this opportunity. So we are happy to answer questions. More questions probably we can take over email and address those questions going forward. So thank you very much, GEPL team.
For all the audience who have joined us, thank you so much. We really do hope that we have clarified your doubts. Hope you enjoyed the session. If you like our episode, please put on your cameras and have a thumbs up so that we can capture you. Like and follow us on Facebook and Instagram to stay updated with our next event. Our next webinar series is exploring new opportunities for retail investors in government securities, which is scheduled on 26th August 2020. Looking forward to seeing you all. We at GEPL will come up with more sessions related to different subjects. Have a good day. Stay safe. Thank you.
Thank you. Thank you, Vivek ji. Yeah. Thank you.
Thank you very much.
Oram Patil, right? How do you pronounce? Oram Patil. Yeah, okay.
Thank you.
And thanks, Sharmila. Yeah.
Okay.
Right. Thank you.